Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Massar and Tim Stenovec from Bloomberg Radio.
The U.S. election next month, 11 days away, will be a clash of visions that reverberates through the global economy for years to come. The election outcome will determine policies on issues like antitrust, capital requirements, healthcare subsidies, tax incentives, tariffs, energy regulations, and as we just kind of referred to, probably what goes on in the digital world.
Well, Bloomberg has done the work on what that means and has the 5 industries with the most at stake when it comes to this next election. For a roundup of it all, let's go to Washington, D.C., where we find Bloomberg News Real Economy team reporter Mark Niquette. Mark, so lay out what you and the team set out to do and really how you went about it.
Well, we tried to sort of identify what industries have the most at stake, depending on who wins the presidential election and which party gets control of Congress, or if it's divided government. So we looked to see, what policies that President Harris or President Trump might enact that would be very different and have a dramatic impact on industries. And we settled on sort of the 5 that we thought would be the most affected. Banks, because of the Basel III endgame difference we could expect under a President Harris versus a President Trump. Healthcare, because of the healthcare subsidies that are expiring under the Affordable Care Act. Tax incentives as they relate to tariffs and the impact that would have on the retail industry. And finally, energy and oil and gas, because of the differences we'd see in how a President Trump or a President Harris would approach energy and energy policy.
So in other words, when you look at those 5 industries, Mark, in some cases, depending on who's in the White House come November or a few days perhaps afterwards, and really who comes to the White House in January when they take over, it could be good or bad for these industries, I'm assuming.
Right. Like in the case of the big investment banks, the expectation is if Kamala Harris wins the presidency, the process that's been ongoing to establish the Basel III endgame, the additional capital requirements for the big banks, that would go forward and probably be finalized, sometime even in 2025. But if President Trump were reelected, the expectation is the rule would be put on hold and maybe never implemented, just because of President Trump's approach to regulatory policy and how he would pursue that. So, if you get a President Harris, you probably have a Basel III endgame finalization. You get a President Trump, you probably don't.
What about when it comes to healthcare? It's hard to think about what the 2 candidates have said about healthcare without thinking back to what the former President Donald Trump said at that debate last month, that he has concepts of a plan when it comes to replacing Obamacare. But that could have serious implications for what these health insurers do and how they do business.
No question. And in the healthcare area, we kind of focused on the extended subsidies that are expiring under the Affordable Care Act. I mean, essentially, these are subsidies that were extended within the Inflation Reduction Act that covered like 3.8 million people who would lose their coverage if these subsidies, which expire at the end of 2025, are not extended. And again, the expectation is if Kamala Harris is elected, she and the Democrats would continue these subsidies, extend them. But if President Trump were elected, those subsidies probably go away or get modified to the point where they're not as useful for the hospitals or the insurers.
Got to talk EVs, and we're going to dig a little bit deeper into the relationship between certainly Donald Trump and Elon Musk. But there has been a lot written, we've reported, on what a Trump administration could mean for Elon's world. Talk about EVs and the policies there and how that could dramatically, impact that area depending on who ultimately ends up in the White House.
Yeah, EVs are kind of a tricky area because essentially we had tax credits and subsidies under the Inflation Reduction Act to spur the production, the purchase of electric vehicles, tax credits for new and used vehicle purchases, and also emission standards that would spur, the production of EVs. And Donald Trump has been very clear that he does not like EVs. He's been campaigning against EVs. He's vowed to repeal what he calls the Biden EV mandate, which doesn't exist, to buy EVs. Essentially he's just said, EVs are bad for the automotive industry and for auto workers. But since, Elon Musk endorsed Trump, he's sort of softened his rhetoric on electric vehicles.
Right.
But it's more along the lines of it should be a choice. And again, in that area, we would expect that if Kamala Harris is elected, those EV credits and tax subsidies continue. But if Trump is elected, they probably are modified. Even if Congress doesn't scrap the IRA, which would probably be necessary to get rid of the credits, Trump would probably be expected to change them or soften them or change the rules regulating EVs and emissions.
Yeah, I think perhaps why a lot of people think it's kind
negative impact.
Strange bedfellows to find Elon Musk so close with the former president as you do get to the final stretch of the election. Hey, Mark, we don't want to give the whole story away. We do have time for one more question. I want to talk energy and what happens when it comes to energy policy under the two different candidates. Just 30 seconds left.
Yeah, in energy, it's all, again, about regulatory difference between President Harris and a President Trump. We would expect a President Harris to continue the Biden administration's approach to regulating, particularly environmental regulations, with emissions, methane emissions and other emissions. But if President Trump is elected, it's expected he, will have a very hands-off approach and even a deregulatory type of approach that would reduce significantly, in a lot of cases, the compliance costs that oil and gas producers and energy companies have to deal with.
All right, going to leave it there. Hey, Mark, great around the world, or at least around the world of U.S. industries and what the election outcome could mean. And you also get into retail, but as we said, everybody can check it out on the Bloomberg or at Bloomberg.com. Mark, thank you. Mark Niquette, he's real economy team reporter at Bloomberg News, joining us from D.C. All right, folks, we're going to stay with the election and now to an important group of voters.
And that is black men. As a Bloomberg opinion column reminds us, a September poll from the Atlanta Journal-Constitution found Vice President Kamala Harris was 10 percentage points behind President Joe Biden's 2020 performance, with the state's largest and most reliable Democratic voting bloc, Carol, Black Georgians.
For more, let's go to Bloomberg Opinion politics and policy columnist Mary Ellen Klas with us from Miami. By the way, she is a former Capitol Bureau chief for the Miami Herald and has covered politics and government for more than 3 decades. So she has seen her fair amount of election cycles. Mary Ellen, so good to have you here with us. First up, step back. Historically, what, if any, trends have we seen when it comes to the black vote?
Well, historically, it's been a pretty consistent situation for black voters. I spoke with Chris Teller, head of the National Black Voters Project, and he has said that really since the 1970s, there's been about 10 to 17% of the black voters have voted Republican, and the bulk of them have voted Democratic. Now, this number, of course, was lower when Barack Obama was president. That's when black voters kind of more dramatically voted with the Democrats. And so his margin was close. The number of black supporters for the Republicans then was closer to the single digits.
What did you find speaking to folks in the area, well, in Georgia, about specifically what they found appealing about Donald Trump? Some really interesting anecdotes in your story, in your opinion column.
Yeah. These are people who were, I spoke to several Republicans and conservative Republicans who were pretty consistently, not all of them had been lifelong Republicans, but many of them had joined the Trump bandwagon. And their reasons were varied. Some of them basically said, it's his values and his conservative Republican values. And I asked them specifically, how can you overlook some of his very bigoted comments, his history of sort of maximizing and manipulating racist rhetoric? And many of them would just tell me, we have to get past that. And they have gotten past that because for them, these other issues like abortion, and some of them suggested, the machismo and having a strong leader were the reasons they supported Trump.
So, as you write in your column, Mary Ellen, you remind us of the birth or lie about Barack Obama by Donald Trump. He paid for a full-page ad in the New York Times calling for the death penalty for the Central Park Five, defended white supremacists who marched in Charlottesville, and suggested policies should shoot Black Lives Matter protesters. So you're saying the folks that you talk to, the Black voters, the Black Americans, they're saying we can get past that because of other issues that are important to us.
Yeah, and I spoke with Chris Thaler, who does this really longitudinal study of Black public opinion. And his explanation is that there's always been a group of specifically Republican Black voters who are able to sort of get beyond the racist rhetoric for other reasons. And there's a lot of literature around Black conservatives suggesting that, in order to be staunchly conservative, because so much of this conservative politics works to conserve these democratic institutions. He said that the research into this shows that they instead deprioritize their racial identity. Now, when I spoke to these folks, they didn't describe it that way. They basically talked about it for many different reasons. But, I guess the bottom line is that, yes, some of these many Black voters there's getting a lot of attention on the number of Black voters that are supporting Trump. But his point was that isn't very different from how it's been in the past. And he was also highly critical of some of these new polls that show, because he says that in order to get a really accurate sample of Black voters, you've really got to get into the demographics and have a really effective sample. And he was dismissing many of these polls as not having that.
Interesting. Yeah, I do wonder as you get into granular between men and women, old and young, in terms of the Black voting public. I do wonder. Super interesting story, and great to see what you found and heard on the ground there. Mary Ellen Klas, politics and policy columnist in our Bloomberg Opinion team, joining us from Miami.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
I don't know about you, but I'm definitely thinking about the weekend. Great time to see foliage, certainly here on the Northeast. It's also a couple of things that you can check out as well, including the latest issue of Bloomberg Businessweek, which you can get unlimited access to and unlock deep reporting and analysis from reporters around the world, including one on China's EV offensive. Check that out, everybody. To become a subscriber, head to Bloomberg.com/subscribe.
Also out this weekend, the latest edition of the Bloomberg CFO Briefing newsletter. You can sign up for that at Bloomberg.com/CFO Briefing. The newsletter comes out on Sundays, and it shares insight from the world's chief financial officers. This Sunday's issue focuses on how CFOs are preparing for the potential of new tariffs after the November 5th election, and it features Kim Henriksson, chief financial officer at the Swedish investment firm EQT Partners. Kim joins us now, along with Bloomberg News senior editor Nina Trentmann, who's here in a studio. Kim joins us from Philadelphia. Nina, first up, just give us an idea of what you wanted to cover in the new Bloomberg CFO briefing that does come out on Sundays.
Yeah, you pointed it out. We'll be talking about tariffs and how companies are preparing for that. Of course, 10 days out from the election on Sunday. I know that it's a big topic for CFOs, specifically those that have long and sprawling supply chains all around the world. And we spoke to Kim this week earlier. He was in New York for the company's first Investor Day. And yeah, so we'll cover that as well.
Well, Kim, come on in on it. You joined us there out in Philadelphia. Tariffs is certainly a big subject on the campaign trail. And to be fair, Donald Trump in his first term certainly laid out some tariffs, and they carried over into the Biden administration. And then again, we're hearing a lot of conversations. Certainly a Trump second term would broaden out those tariffs potentially. How are you thinking about them, and how are you thinking about them as you talk to some of your investing clients?
Yeah, hi. Thanks for having me on. Thanks for the question. I guess, first of all, what we are a fairly global firm by now. We have 312 companies across the globe with significant presence in Europe and Asia. So this would be sort of one topic amongst many that our portfolio companies would be thinking about. And secondly, I would say that our job is to sort of invest our clients' capital across cycles and regardless of what the political spectrum, what part of the political spectrum is in sort of power just then, and I think that will continue regardless of the election result and regardless of the tariffs.
That's interesting to hear, because this is looking like to be, if Trump does win, an administration that has a lot of differences and a clear agenda, and one that's not necessarily, according to a lot of experts, not so great for U.S. deficit, not so great for companies that produce outside of the United States, could have some inflationary concerns as well. Is this time different, or is this time the same, Kim, as other administrations?
Well, I think that you also need to look at the bigger picture and what we and some of our peers are investing behind are huge secular trends, like on the healthcare side, or the digitalization of society, or energy transition and things like this. They will not change based on tariff. Maybe the pace of change will change, but the direction will be the same. And I think we need to sort of lift the discussion to that direction, and that's sort of how we would typically approach these things.
Kim, how do you think about deal making? We talked about the outlook for M&A, for exits and IPOs. Tell us a little more about that.
Yeah, again, what we think about is we try to be prepared, and clearly exits is very, very high on the agenda for the private equity community more broadly, because we haven't delivered enough capital back to our clients in the last couple of years. What we can do is to have good companies that are ready for exits when the markets are amenable to that, and in some parts they may be, but not fully yet. I'd say that the IPO market still is a bit flaky, and M&A markets are typically correlated to IPO.
How do you think about the declining interest rates that we're seeing in the US and other parts of the world? Sort of, will that make things easier for private equity firms?
It will, yes, it will. I think that the way we are thinking about it is that, especially the sort of zero and negative interest rate environment that we had for some time, that is the weird period in history of interest rates. If you have a 5%-ish interest rate, that is absolutely normal, and something, I mean, it's like business school example of interest rates, and something that our business model has to be able to cope with and is able to cope with. Then in a declining interest rate environment, maybe you get some further sort of tailwinds, but even without that, I think the business model of private equity is pretty solid.
Hey, Kim, you are here in the United States. You were initially based over in Stockholm, and I'm assuming trying to help build out the business that you do, certainly here in the United States and in U.S. investments. Having said that, when you look around the globe, you guys can invest anywhere. Where do you see the best opportunities? Is it the U.S. market? No matter what happens come November in terms of the election outcome, is the U.S. your favorite place in terms of finding opportunities? How do you feel about Europe with all of the geopolitical unrest there? Just walk us through some of that.
Yes. Well, certainly U.S. is a hugely important market for us, and I guess me just having moved here is a signal of that. But we have been here for many years. We have 450 employees at the firm here, and we just had our 30th year anniversary down in here in Philadelphia. So US is hugely important. From an investing point of view, we will continue to expand and deploy capital in the US. It is one of the markets that, regardless of the election outcome, will be at the top of the list. I'd say that Asia is the other major opportunity over the next few years, and probably beyond that. And within Asia, in particularly, we are quite excited, continue to be excited about India and also Japan.
Kim, 20 seconds left. Just fundraising right now, harder or easier than it was a year ago?
On the margin, I'd say somewhat easier, but still not out of the woods. And the key to that would be the exits.
Yeah, totally makes sense. And that's certainly been one of the big stories over, I feel like, the last few years. Yeah. Great to get time with you. Thank you so much. Kim Henriksson, of course, Chief Financial Officer at the PE firm EQT Partners, joining us there from Philadelphia. And of course, our own Bloomberg News Senior Editor, Nina Trentmann, joining us right here in our Bloomberg Interactive Broker Studio. Check out the Bloomberg CFO Briefing newsletter. You can find that at bloomberg.com/CFO Briefing.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
The IPO market has not been what many investors would like for it to be. The market for U.S. IPOs, though, is expected to accelerate next year. That's according to senior bankers at BMO Capital Markets, potentially pushing the volume, of such deals to a 4-year high. That's what they expect. We'll see.
We'll see. I want to put some numbers on this because they're out there with their research. Bailey Lipschultz bringing this to our attention earlier this week. He wrote that proceeds for companies selling shares for the first time in the U.S. will probably be between $40 billion and $50 billion next year. Eric Benedict over at BMO's Global Equity Capital Markets, he's the head of that. That's his prediction. It would mark a pickup of at least 32% from what the market has seen so far this year when measuring companies that raised more than $20 million and when teasing out those blank check SPAC firms. It would also be the most since the pandemic-fueled boom of 2021. Data compiled by Bloomberg show.
All right, great backdrop for our next guest. Let's see what Isabelle Freidheim has to say about all of this. She's back with us, and she is the founder and managing partner of Athena Capital. They invest in private tech companies. She is also very active in the SPAC space. She joins us here in the Bloomberg Interactive Broker Studio. Nice to have you here in studio. Welcome back. What BMO is kind of saying about the IPO market to come next year. What are your expectations and why?
Yes, we do very much concur with those views. You took all my numbers, by the way.
You had the same ones?
Yes.
Yeah, I mean, not much in recent weeks on the market. So it kind of seems like BMO is out with the
well,
most
and that's
recent
not
report.
A surprise because with the elections coming up, there's so much uncertainty that few companies would want to try out for an IPO in this environment. And then you have the holidays, so it is expected that the IPO market will recover given a backdrop of lower inflation, lower interest rates, and more confidence and more risk appetite from investors, especially equity market investors who expect yield in equities. To recover, not just in probably not right away in Q1, but probably in Q2, we anticipate to see a stronger market. There are a lot of companies that have filed for IPOs. There's a huge backlog and very much a need for liquidity in the private markets.
Yeah, we've seen that because interest rates have been high. There haven't been a lot of exits for these PE-owned companies.
Do they need liquidity because they can't keep tapping the private markets, or is it just they're getting long in the tooth?
Or do they need returns?
And they've been private for a long time. Exactly, and they need returns.
So investors in our asset class need returns and liquidity. So private equity, but especially venture capital funds and growth funds that have deployed capital into those companies need liquidity desperately. There's been such a shortage of liquidity, a dry out of cash coming through exits. And that's why we're seeing a secondary market in the private market that's so active because investors are seeking liquidity.
You mentioned the election in regard to these numbers. How are you thinking about the outcome of the election determining the IPO market? Does it even matter?
It does. There will be changes. And in particular, the way we look at it is changes as it relates to the regulatory environment. So we're now in a regulatory environment that makes it very difficult for companies to go public, very lengthy, expensive, and it's lengthy and expensive for companies to stay public. So it is a difficult value proposition that adds to the various layers of complications that have existed in the last 2-3 years. And we do anticipate that whichever candidate wins, there will be changes when it comes to the SEC and the leadership at the SEC. Now, of course, the outcomes are widely different, so wide aperture of possible outcomes. But we are of the view that easing the regulatory environment for companies that exit in the public equity markets is an imperative.
What's the regulations that they want eased?
Well, we want regulations to be to make it more accessible for companies to access to public equity markets.
Jamie Dimon talked about this recently too. That's interesting.
Yeah, he did.
And lower the cost. Well, they're heavy. There's a heavy burden, whether it's on the accounting front, on the compliance, on take even ESG requirements. There's a very heavy burden for companies.
Would you say that? What would you say to somebody who pushed back and said, "Well, that burden is there for a reason. It's there to protect investors from not having complete information and from basically not being protected."
Right, from not being a shell company that really, doesn't, we want to know, right? This is the U.S., you think about the American markets, transparency.
And retail investors need to be protected up to a certain point. But you ultimately do a disservice to the industry and to retail investors by restricting access to the number of opportunities they can choose from. The number of publicly traded companies has gradually gone down in the last 30 years by a significant number.
But is that because of regulation, or is that because people realize being
private is nice?
Yeah, look, talking to investors.
Regulations have a lot to do with it.
But also public markets are not kind. You get punished if you're not reaching those benchmarks. You get punished if you're not hitting your numbers. If you're a private company, you don't have to be punished that way.
Sure, but it maintains a lot of appeal for founders. So founders will want to access the pool of capital that exists in the public equity markets, especially in the US, which is the deepest pool of capital in the world, and that has merits. And founders want to have, many of them want to see value in being public, in being out there, whether it creates growth opportunities for their companies or target acquisitions or be themselves the target of an acquisition. There are many benefits that extend well beyond that of being publicly traded.
Well, just to stick on this sort of like this line of discussion, if we think about it from the perspective of folks in crypto who say, we want the U.S. to be a really friendly place to crypto, so companies don't go to other countries to do business, so we can be the beneficiaries of them doing business in this country. It doesn't seem like the U.S. is losing out to other countries when it comes to IPOs. That is, it's still a very desirable place.
That's a very, very interesting parallel, and it is not true. We are starting to see companies go public in their local market. There's no question that if you take a snapshot as of right now, the U.S. still leads, very much so. Better liquidity, better visibility, better equity research coverage, better valuations, deep pools of capital. But we are seeing competitive markets like the London Stock Exchange create a regulatory environment that welcomes companies. That's true in France as well. An easier process. I just ran into a founder last week in Paris who told me that he went public on the Euronext instead of going public in the US because it was a piece of cake, is what he called it.
An easier place to do business than the US, Europe? Who would have thought we'd actually hear that?
That's true.
Yeah, I'm just, I'm curious. So, when it comes to when you talk about the regulatory environment, so what specifically do, young companies or companies that are looking to go public, what are they looking to have changed specifically? Like, I'm just curious about what has ramped up in terms of regulations or oversight or cost that wasn't there. I don't know. Are you saying like 5 years ago, 10 years ago?
Yeah, it's been slowly increasing. So we've seen regulatory requirements around accounting, reporting, trading, and that creates a burden and a cost of lawyers, a cost of, but take even the ESG requirements that are, in it by itself, it's a burden for companies.
Yeah, I also do wonder how much of this is the rate environment too, right? That has prevented, like, when you've got whether it's a growth company, right, that's going public, a higher rate environment certainly makes investors, more skeptical, right, of valuations. And so they kind of look at these deals more carefully. So I wonder how, that was also at play in terms of slowing down the IPO market, or just having a market that wasn't, kind of open to new issuance at this point. So yeah, I guess I'm just trying to figure out, like you said, Jamie Dimon talked about this. So, if you're just saying overall that it's just too much regulation at this point, I'm just curious.
Of course, but that's not the only point. I mean,
Okay.
you're absolutely correct.
I'm just trying to get down to the specifics.
You're
of it.
absolutely correct that investors have adopted a risk-off posture in the last 3 years. But if you remove the last 4 years, so include 2020, that went over, and remove this snapshot of the last 4 years, we're actually on track to replicate what was happening before. And there was already an existing shortage of publicly traded companies.
Yeah, I mean, listen, we've talked a lot about, Isabelle, the amount of private money that's out there as private credit or private equity has grown, that it's given, in some instances, companies, a longer path if they want, in terms of before they have to go public. And it's kind of a luxury. And we've talked to a lot of founders of companies who are like, we'd like to stay private as long as we can, because it gives our company a chance to really grow before we're, under the spotlight, under the radar. The companies that you are talking about that want to go public, have they been private for 5 years, 10 years? Like, what is it?
There's a wide range, and yes, it's comfortable to stay private to the extent that you can find what you need in the private market, and that's not always the case. You might not find the capital that you need, the partnerships, the visibility, the M&A opportunities. So a company that goes public, it's private, but that goes public, can expand their ability to make acquisitions by financing acquisitions with public stock, and that's very meaningful.
Yeah, no, exactly. Hey, real quickly, 20 seconds. SPAC craze. I mean, people have lost a lot of money. What are you seeing on that front? SPACs?
Oh, SPACs. Yes, quickly. Absolutely. They've been challenging. I mean, the IPO market also has been challenging for tech companies. But I do think SPACs are here to stay. We don't really do SPACs anymore, but I do think they will continue to play a role in the tech industry specifically. All right,
Isabelle Freidheim. She's a founder and managing partner of Athena Capital, joining us right here on Bloomberg Businessweek.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, TikTok, everybody. We've got just about 18 minutes to go until we wrap up the Friday trading session and wrap up the... Yes?
We met one today, Carol. You and I met one. A unicorn out in the wild.
What do you mean?
An undecided voter from the state of Pennsylvania.
We didn't meet a unicorn.
We met one
exist.
Today. They exist. We met this person in person today.
We're going to send them that SNL video that you shared with me.
Yeah, so that was from the 2012 election. I tweeted it out earlier.
It still works. It still applies.
Works.
Yeah.
They're out there, folks.
Yeah.
They are out there.
Yeah, kind of
The New York Times Siena College poll that was out, most recent one, said it's under 4% in the swing states of people who are undecided. They referred to it as, quote, minuscule.
Who are these people?
Well, we know one of them.
Yeah, we do. Okay, but it's not our next guest. Or we don't know if it's our next guest.
She's not in a swing state.
She's not in a swing state. But she's really here to talk about the markets. A former Bloomberg colleague, Sarah Ponczek, financial advisor at UBS Private Wealth Management, joining us from Boca Raton, Florida. How much are people talking about the elections in Florida?
Well, first of all, Tim, I would love to see a unicorn in the wild.
I can introduce you.
Yeah, go for it. But people will not stop talking about the election, Carol and Tim. You know, we're starting to have year-end meetings and calls and reviews with clients, and I don't think there's been a single talk that I've had with the client over the past couple of weeks where the election has not come up, to be completely frank. And everyone wants to know, what impact is the election going to have on my investments, on the market, and on my portfolio? And at the end of the day, for our clients, yes. Is there a possibility we're going to see volatility over the next couple of weeks? Yes, we've been saying it all year long, especially in a year in which, if you look across the capital market spectrum, it's just been a complete sea of green. Stocks have been trading at records. Gold has been trading at records. Bonds, although yes, we've seen a bond sell-off over the past couple of weeks, bonds have been moving higher. So it's only natural that we see some volatility in a year in which we've seen stellar performance across asset classes. But when it comes to the long-term implications for portfolios, politics really don't have that big of an impact.
Even if the politics, that's true historically, right? But is that the case even if the politics lead to increased spending, which both candidates are talking about? And that could indeed happen. Yes. That could indeed happen if there is a sweep in one direction or another.
There is concern about policies being enacted that would lead to more spending, that would thereby lead to inflation remaining sticky. Absolutely. That's been a concern for a while now, as the deficit has too. But the issue in, changing your investments or your portfolio around policies even pertaining to spending and inflation is that not only do you have to get the president correct, who's going to win the White House, you also have to know, okay, who's going to win the Congress? Who's going to win the Senate? Are we going to see a blue sweep? Are we going to see a red sweep? Are we going to see deadlock and nothing really get done? Because not only do you have to get all of that right, you then have to know, all right, well, what policies are actually going to get enacted and what policies are actually going to get through and thereby make a difference. I mean, think about where we stood, say, 4 years ago. There were a lot of investors who were betting on clean energy companies, because they believed that we were going to see a Democratic administration. Well, what happened? Those who believed we were going to see a Democratic administration won. What happened to clean energy stocks? Well, they haven't performed great over the last 4 years. So it's really difficult to not only predict what's going to come out of an election, but then predict what policy is actually going to stick and how that's going to affect the markets. So it's more so when we're thinking about, how do you want to position? It's more so thinking about, okay, maybe tax planning, estate planning. Those are the policies that are really going to affect our clients.
Before we get into that, though, Sarah, I do wonder, because both administrations could potentially talk about, or potentially are expected to, I should say, raise the U.S. deficit. Okay, so they're both talking about spending. And of course, whether or not you're in the White House is one thing, whether or not you have a Congress that lets you enact policies that involve more spending and building up of the U.S. debt, is one thing. But many seem to say that the U.S. debt is going to continue to be a problem and it's going to grow. Having said that, then you think about what that means for U.S. interest rates and a higher rate longer term. Are you positioning investors to assume that we are going to be in somewhat of a higher U.S. Treasury rate environment, no matter who's in the White House?
So what we're looking at right now, and also what our chief investment office has been saying as well, is that doesn't mean you steer clear of bonds altogether. Right now, especially for investors who need income, who are more risk averse, it's a great time to be locking in yields. But where do you want to be looking along the curve? Maybe that means you look at, the intermediate duration part of the curve. Look from 3 to 7 years. You don't want to be uber or super short duration, because then your bond's going to mature and you're just going to be facing reinvestment risk. But that also doesn't mean you want to be looking in the 10 to 20 year part of the curve either, because of the risks you're talking about. So yes, within the fixed income space, where are we looking? It's more so the intermediate duration side of the curve that isn't as much, at risk if we do see longer term yields continue to rise from here.
What about munis? Carol's going to be shocked that I'm asking that question.
Oh my
but,
God!
I sit across from Paul Sweeney.
Who is this person?
I sit
next
across
to
from
me?
Paul Sweeney.
Where did Tim Stenovec go?
Paul Sweeney can't get enough munis.
He loves munis.
He loves munis. What about munis?
I mean, munis are a very important piece of clients' portfolios. I mean, at the end of the day, when you're working with high net worth investors, what's nirvana? What's gold? Not gold in the true sense, but tax-free income. Oh my goodness, that's what everyone dreams of. So when you think of munis, yes, there has been reason when you look at taxable bonds versus tax-free bonds. Taxable bonds have performed better than muni bonds have. But at the same time, when you're working with investors who are in high tax brackets, municipal bonds absolutely still have a very significant place at the heart of those portfolios.
Munis.
I love that stuff.
It.
That's
Well,
shout out to
what
Paul
excites
Sweeney.
Tim more than munis? Maybe I don't know, semiconductor stocks or big
Carol
tech,
just
something
made
a little
sure-
bit sexier.
Carol just made sure I was breathing.
I did. I just took his pulse.
She was
I'm like, what?
She was like, "Who is this? Who's this guy who asked about munis?"
I never, you never really struck me as one to get really excited by municipal bonds. But
people
hey,
change,
you never know.
People change.
People
okay?
do change.
The person I was when we worked together isn't necessarily the person I am today.
It's like, hey, honey, you've changed. All right, that's going to do it. All right, Sarah, have a great weekend. Sarah Ponczek, financial advisor at UBS Private Wealth Management, joining us from Florida. Yeah, it's one of those, I don't know you anymore.
Hey, I'm full of surprises, Carol.
This is what makes it fun, everybody.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.